Welcome back to Switzer on Australia's Business Channel. With tapering talk and correction concerns dogging the market, let's see how George Boubouras of Equity Trustees is playing the stock market right now. George, how are you?
I'm well, Peter. Yourself?
Fantastic. Now, you've been travelling the world. What have you been up to?
Yeah, so I spent nearly a month overseas looking to allocate more funds to global equities, global debt, global REITs and global alternatives. So basically, Peter, I'm looking for my pension funds to have a natural hedge and accumulate more global earnings over the next 10 and 20 years.
OK, well, let's talk about that later. Let's just deal with some of the issues that people at home have been worried about. One is, where's the correction? Is this correction going to be delayed until we see tapering or what? We haven't seen a correction for ages.
No, good point. We haven't had a correction, and the definition of a correction is a 10% correction, so double digit. Bear market's 20%. Now, to get that 10%, I suspect it's going to happen between now and March when the tapering begins. Now, this is a bit of a push-pull effect. Just to clarify, when they begin the taper, that basically means the economy recovery is more broad-based, as Janet Yellen's looking for. If it's more broad-based, that means earnings are growing, economy's expanding, and can tolerate a higher bond yield. The point is, when you start the taper, it's meant to be a good news story. I'd like to reflect on that. So there'll be a mini sort of hiccup or a mini conniption or a correction. But when you look through it, the US economy is still well placed to expand in the years ahead.
So that's code for it'll be a buying opportunity for the long-term investor.
Long-term investor, it just averages in or averages out depending on where they are in their life cycle. But on a one-year view, I know one thing. I know that the bond market has got very expensive valuation, dare I say, not a bubble, but very expensive. And I know that the equity market around the world in Australia is around long-run averages. It's not cheap. But when I look at the bond market, it pushes me back into the equity market, and you buy the good perpetual quality earnings that gives me a good consistent dividend along the way and gives me exposure to expanding earnings in some part of the world. And that's what we're looking for in this sort of time frame. So the correction will happen if you're a timer of the market. But remember, timing the market is a very difficult role, but most people are invested in some stage of the market, some percentage through their life cycle. I am overweight global equities, I am overweight Aussie equities and underweight bonds, and I like that play on a one-year view.
Yep, I think you're right too, mate, but then other people have their own choices. Now, let's talk about what you're seeing in the market. And in particular, I noticed that in America there's been a very big inflow into mutual funds over 2013. I think the figure I got was about $167 billion. But the years before, since the GFC, there have been pretty shocking outflows. Yeah. What about the inflow into the Australian stock market? Is there still a lot of money on the sidelines, both in America and in Australia, that could flood in over 2014?
In short, yes, it can. But what stocks? Let's break it up into two. Firstly, what global fund managers would come to Australia, invest in Australia? They typically like things they can't get access to offshore. So they'll come in with a liquid infrastructure asset like Transurban. That is why we have Transurban in the portfolio. It's large, it's liquid, it's got earnings that grow in line with GDP. So that's a good thing to have. They'll come and buy their Telstra in and out. But they're not big fans of the Aussie banks. I understand. But what I'd like to explain to them, and had this long conversation in New York a couple of weeks ago, is what they need to be cognizant of. If they're short our Aussie banks, that's their risk, because Aussie baby boomers are long only invested for the next 40 years of our banking sector for the dividend and the franking. So they can be neutral, not own Aussie, or they can buy the neutral position, but if they want to go short, it's going to hurt them. But I understand from an American point of view and a European point of view, their banks are cheap on a price to book and a one-year forward multiple. I understand that. But they need to also understand that the fourth largest pension industry in the world, Australia, 1.65 trillion, thereabouts, nearly a third of that self-managed super fund. And again, the baby boomer needs that 40-year perpetual play. So from their perspective, they're coming in and out and buying things like soft commodities, so obviously Warrnambool. They like GrainCorp. They like those sort of plays. They'll play their energy. We need global finance for LNG and LNG projects. But they'll also come in and out of infrastructure. Like I said, they'd like Sydney Airport and Transurban. They'll probably like it delisted. They'll come in and out of Telstra but in the main they'd be very bespoke in their allocation. But from an Aussie perspective, the Aussie equity market still gives you that good compelling dividend, lower growth than global, but you also need a bit of global equities in there. So hopefully there's a bit of colour with some points there that I've just raised.
Okay. I will get to global equities in a minute, George. So you heard me talking to Simon. Simon still thinks for the long-term investor, banks are still a pretty fair play. Do you say for the long-term investor they are a reasonable buy still?
Yeah, they are a reasonable buy. For a dividend income portfolio, we just rotate as I do the dividends between the big four banks. We like that. And we like that play, and we understand that the retail investors there, we understand the valuation is expensive, but we're quite happy. As long as their payout ratios don't spike too high, APRA's made the indication about that, we're quite comfortable with the quality of those banks. And if I dare say it, those CFOs of the big four banks in Australia and their teams deserve an award versus their peers offshore. They've done an extraordinarily good job in extraordinarily tough circumstances since the GFC and should be rewarded. Because they've adjusted even to the regulatory overlay that's coming out of the post-Basel III stuff coming out of Europe as well. They've adjusted well and they're good businesses, and people should be cognizant of that when they're investing.
Okay, let's just talk about the market generally. 2014, is it still going to be a bull market, George?
Yeah, I like to think so. You want numbers? I haven't changed them in over a year. 30 June 14, 57.50. By the end of the year, 59.50. The point is, a 6,000 is achievable late next year, early 2015. And the target for people to keep in mind, the old 6,800 number is really a 61.50 number because of the dilution we had with the capital raises. But the point is, more upside versus downside. Now, this is another thing to highlight. Next year, earnings for the whole market, consensus expectation is double-digit year-on-year growth. That's robust. Now, the last two fiscal years has been negative, or the last one a slight negative, but they've been two negative. So we're all in anticipation. But what needs to happen, Peter, are a number of things. Rates need to stay lower for longer. Aussie dollar needs to fall, hopefully under 90 cents to help that earning momentum. And consumer confidence needs to migrate into the consumer confidence needs to improve and continue on that. The business confidence is improving, but the business conditions needs to improve. It's a bit of a mixed picture out there. If you get all of those aligned, you get that double-digit earnings growth for 14, and you'll get a market migrating higher. Remember, it's volatile, it won't go in one direction. By the end of next year, I believe you'll get a 6 to 9% capital gain before the dividend is what I'm factoring into our portfolios.
Okay. Now, you know I've been on a 5,500 target for this year.
Yeah.
Am I going to get there, George?
Yeah, I think you'll get there. Mine was 54.50. We'll get to your target. You're about right. And stocks that's going to help you get there outside of the banking sector are things that are leveraged and sensitive to US dollar being lower and interest rates being lower. And that is QBE, that is Brambles, that is Computershare, that is Amcor. To give you a bit of a flavour, they're the sort of stocks that should be into your portfolio on a lower Aussie dollar outlook. Macquarie Bank, of course, my favourite, and also and interest rates staying lower in Australia, but expectation of migrating higher overseas. Yeah. They're the stocks that will help you get to your target of 5,500 and 57.50 by June next year.
Okay, now you've been travelling, you've been yapping on about global equities. A lot of Aussies just don't know how to get into global equities, and we don't get the franking credits when we play the foreign stuff. So, two quick questions. Why should we play global equities? And if so, how do we do it?
Okay, you should play global equities at different stages of your life cycle as a natural hedge. For example, if you're 40 years of age, having exposure to global earnings and global economic activities, a natural hedge outside of your country. The MSCI has got 2% weighting to the Aussie dollar. There's a big world out there. So that is why someone in their pension, in their self-managed super fund should think about it, because you're getting it in the regular sort of pension phase anyway. It's an important diversification. For example, we've got good healthcare here, but you've got no expansionary earnings in PayPal via eBay, MasterCard, Visa, or the behavioural stocks like Twitter and Facebook and LinkedIn, or the Procter & Gamble's and the Gillette's and the Johnson & Johnson's, or Procter & Gamble and Gillette, but you get your Unilever. So you need that exposure in your portfolio. So if you're in your 20s, 30s and 40s, it makes a lot of sense. If you're a self-managed super fund baby boomer, you don't need it as much because you can activate pension phase at 55 years and beyond. The franking credit, the component works in your favour. But the reality is, Peter, for most people in their life cycle, like the Future Fund, Australia Super, Uni Super, like the big industry super funds, they are looking offshore as a natural hedge for their for their unit holders to invest through a life cycle, and that is why you have global equities.
There would be some people watching the show who keep scratching their head every time you say a natural hedge. Explain what you mean by that.
Okay, I'm retired in Australia. Therefore, if I have 100% invested in Australia, and I'm a young lad, I'm 46 years of age, Peter. In 40 years' time, I go to my pension to kick it along. And if I'm in Australia and something happens bad in Australia, like Argentina, I can't retire the way I want to. I can't pay for my aged care or whatever it may be. Now, if I'm sitting in Australia and I've got 20% or 30% or 40% invested offshore, and Australia collapses, let's just say Gough Whitlam gets into power again and 30 years later you've got a problem, like Argentina or Greece, then my natural hedge is all those global investments appreciate extraordinarily well and pay for my retirement. And that takes it outside of the country I live in. That's what a natural hedge is. The Norwegians have got a fund, one of the largest in the world, that takes all the royalties out of its energy and reinvests it for their future generations, like the Future Fund in Australia, but it has 100% invested around the world in case the Norwegian economy hits a bit of a speed bump. Because basically, if you depend on your supernormal profits from a boom and you keep it inside your economy, it's inefficient and you don't put money away for future. And that's what a hedge means, Peter, is that I have exposure to global cycles, and if you've got a good government in Australia for the next 40 years, you don't probably need that hedge as much. But I like to hedge everything in my lifestyle, Peter, and I like to retire meeting my expectations, so I will have a little bit of global equities in there to help me meet my expectations in my retirement and my family's.
Yeah, well, I always consider you a rock star of the stock market industry, mate, so we might call you the hedge.
Okay, fair enough. I'll take that on board.
All right, buddy. Thanks for joining us on the program.
That's good to be here, Peter. Cheerio.
After the break, we'll be talking to ST Wong. He's a portfolio manager and he really knows his stocks.